welcome to the latest episode of Score Settled. So we are continuing with your CUET-PG exam, Economics 2025, right? And we are going to take up another set of 5 questions in today's video. Let's start. Number 1. Now, which of the following does not constitute liabilities of your commercial bank? First is the paid up capital and reserves. Now, you may think that how come capital and reserves are counted as liabilities? No, it is in the sense that you may be right, but when we take into account the balance of statements, right, then in that case, it appears this paid up capital and reserves, they appear on the liabilities side of the balance sheet. Right? They're on the liability side and not on the asset side. That's why this paid up capital and reserves, even though you've got that investment, but it is still someone else's investment in your company, right? Or in your bank. So as a result, this is a liability for you and this is included in liabilities side on the balance sheet. Okay. Then time and demand deposits, we know, right? They are liabilities. If you're depositing your money in the bank after 2 years, 3 years, 4 years, or whatever be the time period, the bank will have to return it to you. So that is a liability for the bank. Okay. So this is also a liability. Then money at call and short notice. Now this is not a liability. Why? Because we know that whatever money is invested in the call money market, you have to repay it within 14 days, right? Within a fortnight, right? So it is a very liquid market. You can call up your money or the investor can call up your money anytime, right? So within 14 days, you have to pay it back. It can be demanded in that shorter period. So this is not a liability. It is a highly liquid kind of an instrument. Okay. And borrowings, as the name suggests, it is a liability, right? It is a debt. So third is the right answer in this case. Next, very important question. Which of the following is again not correct about the effect of taxes on income and output? Now, income tax lowers the multiplier effect. Yes, because income tax acts as a leakage. It acts as a leakage in your income, right? So you come to a disposable income, the income that you can use to consume or purchase the commodities comes from your income minus taxes. So this taxes acts as a leakage. So definitely when it lowers the overall income, you will have lower money to consume. As a result, it will impact your multiplier. So this statement is true that yes, income tax lowers the multiplier effect. Second statement, very important. Please keep a note of it. Inclusion of taxes makes the aggregate demand curve steeper and hence increases the multiplier. No, this is not right. Firstly, income tax will lower your multiplier always, right? And secondly, if ever you are confused about what the slope of aggregate demand could be, remember that multiplier is always the slope of your consumption curve, right? So if you are lowering the multiplier, the slope of consumption function, which ultimately determines your aggregate demand, is also lowered. And just think logically, if a slope is lowered, so obviously it is becoming flatter. Okay, so instead the correct statement would have been that your inclusion of taxes makes the aggregate demand curve flatter and not steeper. Okay, always remember, if the slope increases, it becomes steeper. If the slope decreases, it becomes flatter. So here the slope, that is our multiplier, is getting smaller, right? So the aggregate demand curve will automatically get flatter. Okay, so this statement is not right. So we've got the answer, but let's just go through other two statements as well. That income tax reduces the induced increase of consumption out of changes in income. Yes, because an income tax, a higher income tax, lowers the income, and automatically it will lower the consumption because of the positive relationship between your consumption and income. So this is also true. Okay, and swings in investment demand have a smaller effect on output when automatic stabilizers such as proportional income tax are in place. Yes, when you have stabilizers in place, so any fluctuation in investment demand will automatically be corrected. So this statement is also true. Hence, we've got our answer as second. Okay. Next, which of the following is not correct about residential investment? Now, before proceeding, we should know what is residential investment. Residential investment in the sense that you're purchasing or you're renovating a place to generate some additional income, probably a rental income. Okay, so that is your residential investment, just a rental income for the purpose of a rental income. Now, it depends on the net real return obtained by owning a house, right? So yes, residential investment depends on that how much rental income you are expecting to earn from it. Then accordingly you will invest in that kind of a market, right? So this is true, right? The combination of high nominal interest rates and high inflation interest rates encourages housing investment. See, from the consumption point of view, you may think that why will a person invest in a house when he is already experiencing a high inflation rate and high interest rate, right? This is from a consumer's perspective. But from an investor's perspective, it would be that okay, if there is high interest rates and high inflation rates, the prices of real estate will also increase. As a result, my rental income will also increase, right? So this can be probably a good residential investment. So this is also true, right? Then the demand for housing is insensitive to the nominal interest rate. Absolutely false, right? So demand for housing is very much related to the interest rate that is prevailing in the market, right? If a loan is available at a cheaper rate, your investment will increase. You will think about applying for a loan, you'll think about investing in housing, right? But when you're already experiencing a high interest rate as a consumer, you will not think about purchasing a house, and that is the problem that today's generation is actually facing, right? Then the cost of owning a house rises almost proportionately with your interest rates, right? So this means that if there is high real interest rates, there would be increase in your interest payments and it will lead to a higher borrowing cost. So this is also true, right? So the incorrect statement in this case is statement 3. Okay. Next. The following are the reasons for a firm to hold stock of inventories. Again, except what? First is to meet future demand for goods. Yes, the firms do keep inventories to meet the future demand for goods. That is true. So this statement is true. Okay. Now it is more costly for a firm to order goods less frequently in large quantities than to order small quantities frequently. Now this is the statement. If you are finding it costlier to keep a huge inventory, so the business person would think that okay, let me just order it in smaller amounts, right? That is beneficial for me. Why should I keep a higher stock when it is becoming more costlier? For example, the cost of warehousing, the cost of storage capacity. If it is high, then the person would tend to order more frequently than to keep a stock of it. Okay, so this is false. Okay, to smoothen the production process, yes, if you are out of stock all the time, definitely this will put a bad impact on your product. Okay, and then some inventories are held as an unavoidable part of the production process. When you need something that cannot be avoided in your production process, you tend to keep the inventory of it. For example, in printing books, you need pages, right, to print the books. So you will keep a stock of paper, rims with you, right, to avoid any kind of disruption. So the correct answer in this case is 2. Okay. Next, commercial banks in India are subject to statutory liquidity requirement. Which of the following is not a part of the SLR? Now, what is SLR? First of all, what is SLR? Pardon my writing. Percentage of reserves that is maintained by banks, right, in form of any kind of a liquid asset. This is maintained by the banks. And CRR is the percentage of your deposits that has to be kept with the RBI. Right? So SLR has to be maintained by the banks and CRR has to be kept with your RBI. Okay, now let's go through this. Which of the following is not a part of it? Right? Firstly, required reserves. Okay, now this is the right answer in the sense that required reserves is the bigger part. Required reserves includes both SLR and CRR as well. This can be presumed like this, right? So, correct answer is required reserves. But let's go through other options. Your treasury bills, asset, liquid asset, SLR. And an unencumbered government and other approved securities. Yes, SLR, government securities are a part of SLR, right? And current account balances with the other banks, again, SLR. So, the correct answer is required reserves simply because it can be presumed as both SLR and CRR. Rather, required reserves do include both your SLR as well as your CRR. Okay, right? So these were the 5 questions. These were pretty easier ones and they were more conceptual. Okay, so do keep a note of this. Always apply logic. For example, in the aggregate demand question, right, which makes the slope flatter or steeper, the multiplier, the effect of multiplier on the aggregate demand curve, these concepts should be on your tips. Always apply logic. Even if you're confused, right? So rather than going in for a rote learning, start applying logic. Okay, so this was all for today's video and I'll see you in the next one. All the best. Take care.